Okay, then we start our today's webinar. I would like to welcome you all to our third joint LMA MLL event regarding the transition from LIBOR to SARON. I'm very happy to see that we have a very high number of participants, and thus can see that this topic is not only of relevance but also of interest to all you here in this call and webinar. I'm very happy to also welcome our speakers and panelists to this evening's event. We have also this year the privilege of having a highly decorated panel of experts, both from the banking side, from the industry side, and as well as from the industry association side. I would like to start with Cam Mahil of the Loan Market Association. Cam is a senior director and also a senior legal advisor to the LMA, and she's a profound expert of all aspects of the LIBOR to SARON transition in all major jurisdictions. So it's a pleasure to have you here. Thank you very much. Then we have Alfred Lederman of UBS. He is the head lending and deposit products, and at the same time also the chair of the loan and deposit market sub-working group of the national working group in Switzerland on the Swiss franc reference rates. Also, welcome to him. Then we have Chris Meadowcroft from Credit Suisse. He's the head portfolio and capital management, corporate banking, SUB. He's also a member of the national working group on the Swiss franc reference rates. And then we have Fabio Caduff, member of the structured finance team of Zurich Cantonal Bank, and he's a member of the transaction team that led the first credit facility transaction in the Swiss syndicated loan market that contained a switch mechanism to compile the SARON, where Zurich Cantonal Bank acted as the coordinator and one of the lenders. And then from the professional borrower side, we have Manuel Gerber from Adecco Group. He's a senior treasury manager. And we have Markus Bieri from Lafarge Holcim. He's the member of the Treasury Front Office, and he's also the vice president of the Swiss Association of Corporate Treasurers, and also a member of the National Working Group on the Swiss franc reference rates. Thank you very much. Then we have also an additional speaker, that's Ulke Zibik. She will start our evening with a short welcome note. Ulke is a counsel in our banking and finance group. Thank you also to you, Ulke. Then we have a presentation of Cam talking about the international aspect of this LIBOR transition. And then we have a presentation of Alfred Lederman on the Swiss aspects before we then start our panel, where we obviously also are looking forward to questions from the public, from our participants. So please also send us your questions, or just raise your voice if you would like to answer any of your questions. So thank you very much. Then I would hand over to Ulke.
Thank you, Alexander. Good afternoon also from my side, and this is our third joint event with the Loan Market Association on the transition from LIBOR to SARON. As we all know, the clock is ticking toward the end of LIBOR, this is the final year. The UK Financial Conduct Authority will stop supporting LIBOR at the end of 2021, and the London Interbank Offered Rate LIBOR is being replaced by the end of this year. In Switzerland by SARON, this is the chosen risk-free rate in the Swiss market. The more this webinar today is of importance, and we will try to give you an update and overview on the latest developments on this hugely topical subject, which is of relevance to everyone working in the financial industry. Today's session will also consider developments on the other LIBOR currencies, because this issue is wider than the Swiss market. As we all know, it's a global issue. In terms of a setup of this webinar, Alexander told it already, we will have, after a brief introduction to the topic by myself, an update from Cam. After this update, Alfred Lederman will hold a presentation before going into a panel discussion focusing on the practical issues arising with the transition. So let's have a short recap first, why we are actually here. The London Interbank Offered Rate LIBOR has been in regular use as a financial benchmark rate since its launch in 1986. It is a major interest rate benchmark which underpins more than 300 trillions of dollars of financial contracts, including derivatives, bonds, and loans. However, the fate of LIBOR was sealed by a statement of Andrew Bailey, the former chairman of the FCA, in 2017. He said it would no longer be necessary for the FCA to persuade or compel banks to submit to LIBOR by the end of 2021. There were two decisive reasons that the once most important reference rate in the global money market was no longer be supported by the FCA. On the one hand, there were these scandals. As we all know, as of 2011, there were a number of scandals due to the unauthorized collusion, which showed that the LIBOR was susceptible to manipulation. And on the other hand, because the underlying money market transactions were missing, LIBOR also lost quality. The regulators since then maintained position that LIBOR should cease to exist at the end of 2021 and pressed institutions to limit new business referencing LIBOR and to develop plans to mitigate and reduce dependencies on LIBOR. Working groups were established to deal with the transition. In Switzerland, this is the National Working Group on Swiss franc reference rates. In Switzerland, the next slide, please. In Switzerland, the National Working Group proposed compounded SARON, the Swiss average rate overnight, as the replacement standard for the Swiss franc LIBOR. In contrast to LIBOR, SARON meets the criteria for a representative and robust reference rate that is also administered in Switzerland by the Swiss Stock Exchange. SARON is a rate that reflects the market conditions of overnight transactions in the secured Swiss franc money market. And SARON is calculated continually in real time and published every 10 minutes. But a fixing is conducted 3 times a day, at noon, 4 o'clock in the afternoon, and at 6 o'clock in the evening. The 6 o'clock fixing, which is published immediately after the market closes, serves as a reference rate for derivative financial products and final asset valuation. There are important differences between LIBOR and SARON. I would like to mention some of them. LIBOR is a forward-looking term rate. That means the interest payment amount due is known at the beginning of the interest period when using a term reference rate in a financial agreement. Whereas SARON is a backward-looking overnight rate. The interest payments are the result of a daily compounded interest rate. While SARON is based on actual transactions and prices, the LIBOR is calculated from the agreements between the banks. And SARON is moreover a daily rate. That means it has a maturity of 1 day or 1 night. And LIBOR, on the other hand, is the interest rate for lending money for a certain term, usually 3 months. And last, LIBOR is an unsecured borrowing rate and includes implied credit risk of the panel banks and the liquidity premium relating to the length of the interest period, whereas SARON includes no credit risk element or liquidity premium and is based on secured transactions. The current status on the transition from LIBOR to SARON is that it is expected that the Swiss franc LIBOR will be discontinued at the end of this year. In December of the last year, the Financial Market Supervisory Authority, FINMA, published guidance on the LIBOR transition in Switzerland. They published a so-called transition roadmap for LIBOR and recommend that the affected supervised institutions follow this in order to be as prepared as they can possibly be for a discontinuation of LIBOR in various currencies. I will not go into the details, but the FINMA showed their LIBOR transition roadmap by which new contracts in general shall be based on risk-free rates by the end of June of this year, and full operational readiness is required by the end of December 2021. After this very brief introduction to the basic background, now let's go deeper and look what happens currently in the market and which developments are going on. I would like to hand over to Cam to get an international overview of the transition to the risk-free rates and developments in the syndicated loan market. The floor is yours, Cam.
Thank you so much, Ulku, and hello to everyone watching. So yes, I'm Cam Marhill, a Senior Director at the Loan Market Association. I have spent quite a few years now working on LIBOR transition and sit across various of the national working groups. Alfred's going to give an update on what's been happening in the Swiss market, but I'm going to cover some key developments internationally, particularly in respect of the syndicated loan market. I only have 10 minutes, so I will do this at a very high level. Great, thank you very much. I think the first thing to say is that we know now for sure that LIBOR is indeed going away. So on the 5th of March, the FCA made an announcement about the future cessation and loss of representativeness of all LIBOR settings, which does make this all very, very real now. And essentially LIBOR for most currencies and tenors will either cease or become non-representative at the end of this year, with some key US dollar LIBOR tenors continuing until June 2023. There are also various working group and regulatory milestones, like the FINMA milestones that Ulku mentioned, to cease LIBOR lending, which take effect at various points this year. And one of the key points to take away is that by the end of this year, all loan market participants need to be in a position to either lend or borrow based on RFRs across all of the LIBOR currencies. The other key point is that even though I said that some key US dollar LIBOR tenors are continuing to be published until June 2023, the regulators have made very clear that this is only to assist the runoff of legacy contracts. So for new deals after the end of this year, banks should cease using US dollar LIBOR. The last point to say on this slide is that the transition of the legacy book is really coming into focus this year, and there are also milestones around that. Again, Ulku mentioned some of those. Credit adjustment spreads are coming up as an area of discussion, as there are recommendations on the spread that applies upon cessation or non-representativeness, being the ISDA historical spread, which was fixed on the 5th of March. But at the moment, there are no recommendations where parties transition before that point. Outside of the Swiss market, there is a lot of focus on so-called tough legacy legislation, which I won't cover because it has less of an impact on the Swiss market. Moving on to the next slide, this just shows you where things stand in relation to cessation or non-representativeness announcements. So you can see from the top of the slide that all tenors of Swiss franc LIBOR are going to cease from the end of this year. At the bottom, you'll see that there are rates where the decision has been made that the rates will not be representative beyond a certain point. And for these, there is the possibility of a synthetic LIBOR for those tenors to help the transition of legacy deals. And synthetic meaning that there would be a LIBOR screen rate, but actually that screen rate is determined by using, for example, for sterling, a term SONIA reference rate plus a spread. Now you can see that because Swiss franc LIBOR is ceasing, there is no prospect of a synthetic Swiss LIBOR rate. Moving on to the next slide and some milestones for the cessation of LIBOR lending. So Ulku already mentioned the FINMA deadlines, which are represented here, and Alfred will cover those in his presentation. But elsewhere for sterling, since the beginning of this month, there should be no new sterling LIBOR loans. And that also applies to sterling options in a multi-currency facility. Now, the UK regulators recently released a Dear CEO letter, which made very clear that any new sterling LIBOR syndicated lending commitment after the end of Q1 milestone would be viewed as a collective failing of all banks in the syndicate. So this very clear regulatory message is driving transition in the sterling market. In Japan, a deadline of end of Q2 has been set, which is also the best practice deadline set by the ARC for no new US dollar LIBOR loans. However, the Fed has actually said that there should be no new US dollar LIBOR loans by the end of the year at the latest. The ARC is not planning to change its June deadline, so effectively we have two deadlines there in the US. But interestingly, the FCA recently said at an ISDA conference that use of US dollar LIBOR, except for legacy deals, should cease at the end of the year in the US, the UK, and other key jurisdictions. So in effect, the end of this year is the critical deadline across all LIBOR currencies. On the next slide, I've highlighted some of the milestones in respect of transition of legacy. So there were some end of Q1 deadlines in the sterling and the Swiss markets for identifying legacy contracts for transition and to come up with plans for transition, including contacting counterparties. And this legacy transition needs to be significantly progressed over the year and completed where feasible by the end of Q3 for sterling and also in Japan. We'll talk more about legacy transition in the panel discussion. So let's move to the next slide. So I thought it was worth just having a slide giving an overview of where conventions for syndicated loans are now since our last session in September. Alfred is going to cover the conventions for Swiss francs and how they interact with the international picture. But just to say that we do now have recommendations across all LIBOR currencies, with final Euro recommendations expected next month. And the key point is that whilst there are some differences between the currencies in their approach, as you can see on the slide, so for example, in the US and Japan, they talk about simple interest being an option. There is optionality that's provided for in the conventions, which do allow you to get to a consistent position. And critically, the basic compounding formula for compounding in arrears is the same. The one thing I would flag, and we'll talk about this, I think, a bit more in the panel discussion, is that the US picture for loans is a little bit more mixed because there is currently an ongoing debate about use and availability of SOFR term rates. There are now credit sensitive rates that are available. And there's also talk about using SOFR averages or a last reset methodology. So we're not quite sure yet where the US domestic loan market is going to land. But in deals that we've seen in the London, the European and the Singapore market, certainly compounded SOFR has been used. Another point just to flag is on derivatives and the fact that ISDA documents contemplate using an observation shift and a 2 business day look back. So there is an issue here of basis risk with loan conventions not completely matching derivatives. However, this has been recognised by ISDA and the fact that cash markets need different conventions and also look back periods. So ISDA has been working on some rate options which would allow market participants to select conventions which are being used in the cash markets for derivatives. And we've been liaising with ISDA on this to ensure that the wording aligns with loan documentation. So I think that's a really great piece of work from ISDA, which hopefully should be out shortly. So moving on to the next slide, I'm not going to run through this, it's just really for information, but it picks out a selection of recent deals referencing RFRs in the loan market. And we have the full list on our website, although I will say that the loan market is private, so the list is by no means comprehensive, but it does include links to deal interviews that we have done, including with Dormakaba and ZKB on their deal, so definitely worth taking a look at. The deals in the darker colours represent switch transactions, so where you have a LIBOR loan with an inbuilt switch mechanism to RFRs, whereas the other deals are based on risk-free rates from the very beginning. So there are some Swiss deals noted in the table, which I'm sure we'll touch on in the panel discussion. So moving to the next slide. This shows what's happening with LMA RFR documentation. So we originally published some exposure drafts, which were changed to recommended forms at the end of March this year. The slide sets out the spectrum of approaches which are in our documents from, I guess, the weakest to the strongest. I'd say the first two boxes which I've grayed out on the slide are not as relevant anymore because we are at the end of April now, so parties really need to be aiming for more certainty in their transactions. So I would focus on the rate switch agreement, a new day one RFR facility agreement. And we have two versions of each facility agreement available. So one based on lag, one based on observation shift, given the optionality that's provided for in the loan conventions. There is actually very little difference between the two versions, except for the calculation schedule, but we have just kept them separate just to make things easier for people. And in terms of the day one RFR facility agreements, the multi-currency document is, I would say, relatively complex, but it is a very useful document because it does allow you to mix and match different approaches and stagger the transition of different currencies, because we are seeing different currencies moving at different timelines, as you would have seen from the timeline slides that I've showed. So the documents use Euribor alongside compounded SONIA, compounded SOFR, and compounded SARON. And there's also a switch mechanism which is built in for Euribor or other IBORs as well. So you can sort of mix and match and transition and stagger as you decide on your deal. And we then have documentation for legacy transition, so the reference rate selection agreement, which is in the process of being updated. And it's worth saying that there are two options out there for legacy deals. So either you could move to risk-free rates directly, or you could use a rate switch mechanism. We also recently published some notes outlining considerations for different sector areas, so relating to, for example, export finance, leverage finance, real estate finance, and we're also currently updating our suite of documentation, starting with our investment grade and real estate finance suites. So moving on to the next slide, and just to finish up, I would end by saying that the frameworks are largely in place to support syndicated loan transition to RFRs, and certainly RFR-based deal flow will be very important in order to drive adoption and also familiarity in the market. There is still work to do to help underpin the transition, and the elements outlined in this slide around education, systems, legacy, and multi-currency will be considered in the panel discussion. So time is short, not just for my presentation, but also for LIBOR transition. But we are all in this together because the transition does affect everyone. I have included my contact details on the next slide, so do feel free to get in touch after the session today if you have any questions, or do ask in the panel Q&A. But for now, I think I will hand over to Alfred to cover what's happening in the Swiss market.
Can you hear me now?
Yes.
Yes. So again, good afternoon from my side. Thanks, Cam, for your introduction. I think I will reiterate some of the points which were already mentioned, but given the importance, it might be even worth to reiterate them again. So when we start with the first slide, and we heard that basically the whole transition program, programs for the banks, for example, started back in 2017 with the famous speech of Andrew Bailey. Now, the next big milestone has actually happened on March 3rd this year. It was quite a historic day for the LIBOR transition, as on that day, the announcement have basically put an end date behind all currency tenor pairs. And what we wanted to show you on that slide is just a simple graph on how you can read now the cessation dates. I think if you look at the Swiss franc situation at the bottom, this is the most straightforward situation. There's not been any discussion on alternative forward-looking or credit-sensitive rates. and it is clear that by end of this year, Swiss franc LIBOR will cease to exist. Now, the situation in dollar and in sterling is a bit different given the huge legacy book referencing still LIBOR. The currencies have taken a bit of a different approach here. US dollar LIBOR, we will see some publications in the 1 month, 3 months, and 6 months tenor points until June 2023. All other currency tenor or all other US dollar tenor points will cease to exist. And again, as Cam already said, we cannot use these published LIBOR rates in any new contract, but only to facilitate the legacy contracts. The approach which was taken in sterling is a bit different. There, sterling LIBOR will cease to exist. However, there will be a publication of a so-called synthetic LIBOR, which again has this, will be published for the same purpose, to just run off the legacy book. Any new business is not allowed to reference that synthetic sterling LIBOR. Situation in euro obviously has always been very different, given the Euribor will still be in place. And I think in Japanese yen, we also see the situation there. We have also term rates there, and TONA and TIBOR, and there will be a synthetic LIBOR until end of 2022. We heard already that in dollar and sterling, a discussion on credit sensitive and term rates is still ongoing. This is somewhat also, the whole market is waiting for a clearer guidance on that. And for us, I think also a reason why Swiss franc is probably most advanced when we look at these currencies, because simply we had no other choice than moving forward. If you go to the next slide, then FINMA came out with a guidance back in end of 2020 to lay out a transition roadmap for 2021. The first milestones have already been passed, which is the signing of the ISDA fallback protocol. Also, banks had to ensure that they are ready to grant loans based on these risk-free rates. One point that FINMA is now highlighting, and we heard it also from Cam, that in other jurisdictions there is far more discussion on legislative solutions for this so-called tough legacy. You find the definition of tough legacy, a FINMA definition, also in the footnote below. But given that there is no legislative solution in Switzerland, the FINMA put a lot of emphasis that banks would first of all ensure initial contact with these counterparties will happen, and that the milestone was already by end of March. And also forward-looking that these risks need to be mitigated until June 2021. On top of that, all new contracts should in general should be based on RFR. And by end of this year, obviously, as LIBOR will cease to exist, there's no in general anymore. There's just we need to base basically as of the new RFR rates. One thing that is probably different on that slide already is when we say announce discontinuation. Now we know that this is now for certain that by end of this year, Swiss franc LIBOR will cease to exist. So that is a more general market update, and I will deep dive a bit more on the lending side on the next slide. Go in one slide forward. Exactly, thanks. And that's a slide which I have shown and presented to you already, I think, last year, showing again the different options on the left side and also on the right side now what has happened in the market in the meanwhile. So again, just to reiterate, when we thought about how can we use SARON or any overnight rate in lending, there were different options discussed. You see them here. There were two methodologies, one the in arrears, one the in advance, and there was even a kind of a mixed methodology. And the basic difference is that obviously in the arrears, the interest would only be known at the end, that would be the plain, or close to the end of the interest period. In the advanced solutions, which you can see here, you will have a complete shift of from the observation period to the interest period, and hence, as you would fix the rate at the end of the observation period, you would know the interest already at the beginning of the interest period. Now, we have also put in red back then where we were not allowed from the Adecco to give any kind of clear recommendation for just one of these options. But we were allowed to give some kind of a feeling where the center of gravitation or the center of discussion is diverging to. And what we have seen that obviously the plain, the look back, and the last reset options have been the options that banks were looking into much more detail. And now looking on the right side, we have now seen banks coming out with basically every bank offering RFR loans based on these three different options, which were highlighted on the left side. With that, I think Switzerland is kind of leading the market. We also see that the volume developments are quite positive. Clients are accepting this offering quite well. So I think, again, we are here in a really leading situation. But again, that was also given that we have LIBOR mortgages, and LIBOR mortgages were a mainstream product here in Switzerland, and we had to find a solution for this product. If we move then forward to the next slide, one thing that was already mentioned before, when all these different national working groups came out with their recommendations, we have seen that we in Switzerland, or in the Swiss franc national working group, we have taken an approach which was very much in line with the derivative side. In the meantime, there were also then so the US dollar group, the sterling group, and also the euro group came later with some recommendations which are in three main areas diverging from what we have seen or were recommending for the Swiss franc. The first area is on the term rate methodology itself. I think all currency working groups are recommending the compounding of these overnight rates. And as Cam already highlighted, there's still a discussion in the US dollar, in the ARC working group, to also use a simple methodology. Then the other two areas where we have seen diverging conventions is one with regard to the look-back option. That there's a difference in how you calculate the compounded rate. In the so-called lag methodology, you are just moving the observed rates, but apply the weighting of the respective interest rate. In the shift methodology, you actually not only take the rate from the observation period, which starts, for example, 5 days earlier, but you also take the weighting from these days. So the difference there is a bit of a technical one, and in reality, the difference when we did the numbers was very minor in around 1 basis point. But this is one thing that we need to obviously be aware of when we talk about, for example, multi-currency facilities, that there might be different conventions in the market. What we have done in the meantime is that you have seen also the Swiss franc group, but also the UK saying that the other, so where that the recommendation was to use shift, like for example in the Swiss franc group, the other options have been put as an alternative solution as well. I will come to that in a second. And also for flooring, as you can see, there was a discussion whether to floor the individual observed reference rate or only the compounded rate. And here again, there were some divergences. And when we go to the next slide, when we discussed that in the National Working Group last year, what we said is that obviously we have seen the domestic market very much evolving along the conventions that were chosen and recommended by the National Working Group. However, we also said that in a more international context, so for example, when we talk about multi-currency facilities or syndicated loans, we also need to consider conventions from other currencies, and that's why we have also put into the recommendation that in case of international or international business, such consistency is important, and the lag methodology or the flooring of individual SARON values is a viable option to what we have recommended in the Swiss franc National Working Group with a more domestic focus. So I think this is a bit of a technicality and things that, however, need to be considered in the contract. If we move to the next slide. Thanks. One thing where we also wanted to help then the corporates and also banks to simplify the transition, especially for syndicated loans. From the National Working Group, we have worked together with Baker McKenzie, and Baker has drafted an amendment agreement for Swiss law governed syndicated credit facility agreements. This rate switch amendment agreement introduces a mechanism for the switch from Swiss franc LIBOR to compounded SARON based on these National Working Group conventions, which I have highlighted before. The basic assumption is that this switch amendment agreement is applied to a facility which is on Swiss franc, so single currency credit facility in English language and governed under Swiss law. I think it's important to say that some commercial points, such as break costs, are intentionally left out, and some others have been indicated as optional, as there were still ongoing discussions, and it will be then up to the banks and the borrowers to agree on these commercial points individually. Maybe one other remark for this rate switch amendment agreement, it can also be used with some twists in bilateral loans and also for multi-currency agreements if the other rates are forward-looking term rates, such as in particular Euro and Euribor. You can find the respective documentation also with this link on the slide. Then if we move on to the next slide, please. One of the biggest discussion, I think especially the corporate treasurers then can allude to this much more in the discussion later on, but one of the biggest headaches was always these intercompany loans, as LIBOR is also very often used in these intercompany loans because of two reasons. First of all, LIBOR is recognized as a reference rate by global tax authorities, and also LIBOR is basically it has the advantage of being a forward rate, and this has been also been quite intensely discussed in the US dollar group, and the ARC has come up with a quite pragmatic proposal there, which they have now also documented on their homepage, which is to just use a 30 or 90-day average SOFR set in advance, so that if you go back to slide 5, where we have seen the different options, which would be the two in advance options, last reset and last recent. and use this rate and as a forward-looking rate for this intercompany lending. Now, the advantages of this proposal would be, I think, the broader the acceptance of such a solution is, the better, especially on a global scale, and it seemed to be very important for corporate treasurers also that the solution is simple to implement, and with a 30 or 90-day average SOFR set in advance. This is much more similar to what we already have with the LIBOR setup, so with a forward-looking rate. However, that would obviously expose any corporate treasurer to some kind of a basis risk, given that within the company you will on lend with an in-advance solution, and most likely some of the external borrowing could be in arrears, and that is something that needs to be considered. Now, again, there was a discussion out of the US dollar group. We have also taken this proposal now and are currently in discussion with corporates in Switzerland. We have sent out a questionnaire and have also hosted a webinar on that topic together with the Swiss Act Corporation. That brings me to the end of my presentation, and I would hand back to Alexander.
Thank you very much, Alfred, Cam and Uku for these introductory presentations. I guess summarizing up what already has been said, we heard all about the UK Financial Conduct Authority's announcement in early March that by the end of this year, LIBOR is going away. Now we know it for sure. We heard about the FINMA roadmap for the transition that now forces particular financial institutions to come out with new products, SARON-based products, and by disallowing using of LIBOR, FINMA has put a lot of pressure now to that SARON products are used, and FINMA also follows up on a monthly basis. So a lot of bigger financial institutions have to do a monthly assessment where they stand with the transition, and they have to communicate to FINMA also what they do about their tough legacy exposures that both of you have alluded to. And so we, as was already said, we don't have any safety nets like kind of LIBOR rate, artificial LIBOR rate, synthetic LIBOR rate that will continue, that we can use. So we have to change, as Alfred said. And so let's now look at some of these new developments. We have heard also about the 500 million syndicated credit facility from KABA that was done by Zürcher Kantonalbank. Cam, you have mentioned a couple of other transactions in Plenia. But let me start with one first question. If we look at the COVID impact also on the timeline in Switzerland and internationally, Cam, has COVID not slowed down the whole transition, first from an international perspective?
Yeah, thanks, Alexander. So, I think COVID certainly, it led to a lot of increased activity in the loan market, with obviously people being focused on liquidity and borrowers being, focused on their survival and getting them through the pandemic. So I think a lot of people expected the transition to take a bit of a back seat and for the deadlines to be sort of pushed out, given, I don't think anyone expected this to happen, and it really sort of took focus away. But I'd say that the regulators took quite a hard line internationally, and they were sort of very much adamant that COVID should not impact overall LIBOR transition deadlines. And actually overall, the timeline didn't change. There's always been an end of 2021 deadline, and that's what the FCA has announced this year. However, there was an acceptance that there needed to be some delays to some of the interim milestones that we covered earlier, because COVID certainly did impact the capacity to focus on sort of RFRs during that period. And I think one of the clearest examples of this was in the US, actually, where they had the Main Street lending program, which initially the Fed put a requirement on the use of SOFR in those facilities for the emergency loans, but then had to change that back to US dollar LIBOR because it became clear that people weren't ready sort of, this time last year to be using SOFR for those loans. And another example was in the UK, where the interim transition milestones were pushed out by 6 months. So initially 1st of October was actually the deadline for no new sterling LIBOR loans, but it became clear that the market just wasn't ready to meet that milestone last year, particularly with the impacts of COVID continuing. What I would say is that the regulatory pressure on banks, I think, continued really during that period to be ready for transition. And certainly in London, we saw that many banks who'd set up their LIBOR transition teams, they still remained very much focused on LIBOR transition during that whole pandemic. So, the banks were expected to be carrying on working on LIBOR transition so that they would be ready, so that when the borrowers were able to then focus on transition, they would sort of be there. So I think that's what's really enabled the end of 2021 deadline to stick.
Thanks, Cam. Alfred, what would you say from a Swiss perspective?
I would very much echo what Cam just said. And I think just adding one Swiss element, so there was not a lot of room for us to postpone any milestones. We had to act very quickly to bring these new products. And as I showed in the presentation, I think all banks have now delivered on these products. My worry is a bit that for obvious reasons, from a borrower perspective, the focus has a bit shifted. Probably for good reasons, liquidity planning, etc. So I think from the proactive dialogue between bank and borrower side, there we have seen some kind a bit of a less activity that we were expecting, and I think we need to catch it up now, because again the deadline is given. And there will be quite an intense last sprint to the mile, to the point. Then.
Thanks, Alfred. Now, if I turn to Fabio and Chris, from your perspective, what were then the impacts of the pandemic on the Swiss syndicated loan market in general?
Well, until the outbreak of the crisis, most issuances in the local syndicated loan market came from refinancings. And as the pandemic intensified, I'd say around March and April 2020, we quickly saw that the demand for financing security considerably increased, as companies were seeking to secure liquidity through committed lines, and therefore we also observed more new syndicated loans in the market. At the same time, we have seen, and to some extent we still see today, many amendments and waivers. But I would say that the situation returned to almost normal levels relatively fast. Already in summer 2020, the situation calmed down and normalized. Overall, I think it's worth mentioning that all banks helped to cope with the crisis and reacted very flexibly to the required amendments and also to new deals. So from our point of view, there was no funding shortage at any point in the Swiss syndicated loan market during that crisis.
Thanks, Fabio. Chris, anything to add?
Yeah, so maybe to add to that, I mean, obviously, while the industry itself was very heavily absorbed with dealing with the impacts of COVID, obviously behind the scene, like was already said, the whole work on LIBOR transition obviously continued. It was very clear that deadlines wouldn't be pushed back. So we were sort of juggling those topics in parallel, and there's also a lot of work that we actually did throughout the COVID time, obviously internally, but also within the Swiss National Working Group, to come up with solutions that we knew we would ultimately need as we transition the syndicated loan market from LIBOR to alternative reference rates.
Thanks, Chris. I would also like to reach out to our participants in the audience, if I can quickly ask you on behalf of the panel participants for a couple of answers. First, a kind of more of a fun question: when did LIBOR officially started to be used? Most probably not anyone has been in the market back then, but maybe you know it. Then we can move on to the more serious questions. We can move on then to the next question. So we get the answers and you get the answer. The right answer is 1986, just to also cover that. Then we will go to the next question. Just to get a little bit of a feeling how far the market participants outside of the world of the financial institutions have already started actively working on this transition. Thank you. So let's go to the answers, just to get a little bit of a feeling. So that shows that a lot of work has already been done and is currently being done. Thank you very much. Now we would move on to the next and last question for our audience. Before we then continue with our panel discussion. Thank you very much. Let's see what the answers were. Okay, thank you very much for your answers, and thanks for the support team for juggling these queries. Interesting. Thank you very much. So let's move on then to the next question. If you look at the differences where we are in the loan market, I think Alfred already alluded a little bit where we stand from an international point of view in Switzerland. Cam, can you confirm what Alfred said, that we are a little bit ahead of the crowd, or do you see that differently?
No, I agree with Alfred, and I think I'd put probably the UK market in a similar box, because as I said, we've got this milestone now in place and some very, very clear regulatory messaging from the FCA and the PRA in the UK that new deals from the 1st of April need to be based, at least for sterling, on an alternative reference rate. So, you know, there is transition that is having to happen in the UK market. So we've got those milestones in place, but I think also there's a lot of clarity now about the conventions having been settled. There's also now a forward-looking term rate available and some very specific use cases around that as well. I think one of the differences as well, I guess, in the UK, which has made the transition a little bit easier, at least in the bilateral loan market as opposed to the syndicated market, has been that particularly at the lower end, a lot of deals have been using the Bank of England base rate. So that certainly helped the transition at the smaller end of the market as well. So I think the Swiss market is then broadly sort of similar then as well, because as Alfred said, you know, there is this clarity of what the direction of travel is. You've got the sort of conventions there, and again, I'd say the building blocks are pretty much in place. Of course, there's some elements, as Alfred already mentioned, around things like intercompany loans and trade finance and those sorts of things. But from a syndicated lending perspective, I think, you know, it's very clear what the direction of travel is in the Swiss market. And I think it's also been really interesting to see the pickup of the rate switch mechanism in the Swiss market as well. So I think that's been really quite positive to see. I guess there are some differences between the markets. As has already been mentioned, that the forward-looking term rate is something in the sterling market and also the US market, but it isn't in the Swiss market. So you, I guess, have some clarity there about what your options are, and there's no prospect of the synthetic Swiss LIBOR. So again, it's very clear what has to happen with legacy, whereas in the UK, I'd say what the difference there is on the legacy side, people are still sort of waiting for the legislation to be passed, which it hasn't been passed yet in the UK. So people are still waiting to see what happens there. Will there be this synthetic LIBOR? Will the legislation come into place? But also, it's not a cure-all. So it's not that there's this synthetic LIBOR and it's a magic wand and everybody can use that. So the FCA has also said, well, we might limit the use of that. So it's not by any means sure that tough legacy will be solved by that. So I think that's an element in the UK market where people really need to be thinking about actively transitioning their legacy deals as well. So yeah, I would agree with Alfred's analysis.
Thank you, Cam. Chris, Fabio, anything to add from your side?
Well, I guess in the sorry, Fabio.
No.
I guess what Alfred pointed out earlier on in terms of differences in the Swiss syndicated loan market versus potentially the more international loan market relates to sort of the more technical conventions, I would say. Like you saw earlier on, the Swiss primary recommendation, for instance, is to use the look back with the shift and a lag as an alternative. Internationally, we see it being the other way around. Also, there's been quite a bit of discussion in recent months about using cumulative compounding versus daily non-cumulative compounding. And I guess the direction that we're sort of seeing the market heading is that if you have syndicated loans that are sort of focused purely on the Swiss market with Swiss participants, they tend to follow sort of the Swiss primary recommendations. But clearly internationally, we do expect deals to follow sort of more the international recommendations in terms of the convention and also the daily non-cumulative compounding. So I guess that is a bit of a challenge for participants, and not least also for the agencies ultimately to be able to deal with the variety of different setups that we will see in the next few months as these legacy contracts transition and also as new contracts get documented.
Thank you, Chris. Fabio?
I think more generally, there are some major differences between the Swiss loan market and European markets. The most obvious would probably be the fact that the Swiss market remains largely private in nature, and therefore transparency remains low compared to international markets. One example would be the absence of league tables in the Swiss market. And then there's also an important distinction, I think, to make between the Swiss local market on one hand and the Swiss market in general, because large caps like Novartis, Nestle, or commodity traders like Glencore, obviously they're not part of the Swiss local syndicated loan market. They follow a more international deal structure. And then there's a couple of specialities in the Swiss market. We usually use Swiss-style LMA documentation, but based on Swiss law and on Swiss jurisdiction. Then there's the 10-20 non-bank rule that's adhered to in Switzerland. And last but not least, the Swiss banks usually follow a take and hold strategy. That's because the participation in syndicated loans is seen as a way to diversify their credit portfolios. And therefore, the secondary loan market is nearly non-existent in Switzerland.
Thanks, Fabio. Let's switch the market side. Markus, Manuel?
Yes, we are exactly now in this position, which was just mentioned. We are in the process to renew our syndicated loan facility with about 20 banks, all international. And it's a very nice experience for the time being because all the banks involved now, first of all, the ones being more involved, which then will manage the facility. They don't have that much experience with other such products already dealt. So they very much rely what they can see in the market. And then, of course, you have the lawyers on the other side, which give you good support. They come up with other ideas and say, look, this is not so fixed. We could discuss here and there. But nevertheless, finally, we have to please 20 banks internationally. And as you have seen before, how diverse things can be seen in different jurisdictions for different currencies. And our facility is a multi-currency facility. So here it's not easy for the time being to find the right approach. So most probably we go for the approach what was already seen in the market and take it from there. But most probably going forward, this is not the market standard, because otherwise it would be a little bit strange that the first transaction seen in the market would then become market standard only because parties don't want to move. But it's a good experience for the time being to see that we're all in the same boat and nobody has a lot of experience, and finally we have to find a good solution for all the parties involved.
Thank you, Markus. Manuel?
Yeah, I think we are in the same boat as Markus said. As a global company, we are more focused on the international syndicated loan market. We have not borrowed in Swiss franc recently, so we would not have drawn any kind of loan or credit line in Swiss franc SARON. What would we have more seen? It's like on the derivative side with the ISTA protocol, which we have signed end of last year, to be sure what happens with our interest rate swaps, which we have still a Swiss LIBOR exposure. So I think that helped a lot, that there is more clarity now, and also with the finalization of the ISTA adjustment spread, so that we actually know what will happen to the floating rate part of our interest rate swaps.
Yeah, thank you. Markus, you have already started a little bit with the experiences and lessons learned so far with the transition process, but would you kind of want to continue and share some of your views, or also what you see from your Treasury Association, what other members' views are?
Yeah, I mean, the topic here is very much related to multi-international companies being active globally, which face the bigger issues, as you have seen before. If you're working in Swiss franc base only, it is more regulated, whereas you have more difficulties when you're really internationally multi-currency and have to deal with several banks instead of just one bank. We have made some information to our members in Swissect, but until last year, it was seen as a topic, but not as a high priority. And now we had COVID, where financing topics were much higher on the agenda than LIBOR transition. But it really picks up now that companies really have to think about how to transform, mainly intercompany loans. What can be kept, what has to be changed still this year. But I'm not sure whether it's already a burning topic. That is what we have seen, Alfred, as well, when we did the survey. I mean, we have asked many companies to get some feedbacks, but in my opinion, the response was rather low. I would have expected much more to participate. I don't know whether they were simply too lazy or were not really ahead of the topic when we asked them just recently.
Do you think this lack of many precedents is also a reason why people have kind of stayed behind their desk and follow more kind of a wait-and-see approach?
No, I believe we have another point here to mention, which is different on the corporate side than on the banking side. corporates mainly rely on third-party IT systems, be it SAP or other ones, and they have not released the new versions yet. So we are still waiting for SAP to release a version that we can compound interests. So until we don't have a system available, we will never ever capture such deals, because we cannot do that on a manual basis. It would drive our whole organization crazy. So we really have a little bit a lack there, that the systems are not ready yet.
Okay, thanks. Manuel, would you support that statement, or how do you see it from a borrower's perspective?
Yeah, exactly. I think we looked at it by running side, which are the derivatives, and also our syndicated facility. I think this was really the points where we were working on. The derivatives already mentioned, and on the syndicated loan, I think that we see also the pressure that comes now from the banking side to, if you have still a facility, which most have, which is related to LIBOR, that this needs to be amended throughout this year. So we will start working on that together, with our lawyers, and together with our agent bank to work on this. And then on the internal side, which is from a volume perspective much bigger for us as a corporate, but exactly as Markus stated, due to the not yet delivered updates on the systems, on the treasury management systems, so there is no real possibility to put a new intercompany loan with new rates into the system. So that's, I think, most corporates wait to really put that into place. So and as for the intercompany loans, there is not so much pressure as for the external side. So it's also easier to wait until there is more clarity with what is an agreed market convention. And as I think was stressed before, and now as the US side with the ARC maybe proposed a simplified version, which could be used for intercompany loans than for external borrowing, and that might even help to make it easier. But I was quite surprised in your survey that I think it was 12% that saw intercompany loans as a low risk. But I think just when you look at the volume, I think that I was surprised. Yeah. I see that as a bigger issue for handling that. Yeah.
Yeah. Okay. Maybe can we quickly talk also about the Euribor kind of stake here? I think Alfred briefly mentioned it, that Euribor kind of will stay the way it is for the time being. So what impact does that have on the borrower side, and what kind of optionality do you see from that fact?
I mean, Euribor is great because we don't have to change anything for the time being. We can make our first experiences in other currencies. And I'm sure there will be one day in alignment as well on the euro side. But it helps a little bit in the transition that we don't have to change everything from the very beginning. So all the market participants can make their first experiences in other currencies. And when then the markets have established and everything is clear, then most probably we can as well switch the euro positions into kind of a risk-free rate position on our side. But we definitely have to address it, because we talk about the syndicated loan facility for the time being, and euro is one of the currencies there in this facility.
Yeah, maybe we can briefly here branch out to more retail loans. There was a question from our participants. What is your view on the EU outreach regarding Swiss franc LIBOR to SARON transition for retail loans? Do you think the EU will use its powers and declare fallback rates and spread adjustments to Swiss franc transition based on last reset as proposed? And what impact will that have on Swiss banks currently using backward-looking rates? Alfred, can I give that to you?
Yeah. So yes, there is this discussion with the EU. We are aware that obviously Swiss franc is also used in other countries in the EU. We don't expect that this will have any impact on the domestic borrowing or lending business. As again, this discussion that we had on its compounding possible under Swiss law, I think we had mentioned this and tabled this also in the national working group meetings, and it doesn't seem to be an issue under Swiss law. It seems to be an issue for some countries in the Eurozone, and there obviously the way out is to use an in advance solution instead of relying on an in arrears. But I don't expect that this will have any impact on the domestic business again.
Thank you, Alfred. We got further questions from our audience. Maybe I can tackle those as well. Do we have already a robust solution for an alternative reference rate for CTF transactions? May I ask our panelists, Alfred, Chris, Fabio, anybody wants to take a first shot here?
So I'm not I could not answer that question, to be honest. I would need to go see if there's a discussion on discount products in general. But if we have already a robust solution, I cannot answer that right away.
Thank you.
Chris, I don't know if you have.
I mean, it's obviously still something that's being discussed at the level of the NWG, but I think that's still work in progress. I'm afraid we're not able to answer that question at this point in time.
Then there's a third question regarding the repricing in case options are transitioned from Swiss franc LIBOR to SARON, and how active are discussions to deal with these effects in the Swiss market. I don't know. I know we talked about that, Markus, on another occasion. Anything you want to say to that question? Or obviously anybody else from the panel? If not, we leave that question for later on, and I would say let's.
Alexander, what I can propose is that we take these two questions back to the NWG. This one is one of the questions which is discussed in the derivative sub-working group, and I can address it there. And let's discuss then how we can, whatever answer comes back, then how we can circulate it in that round. But we can take it back to the national working group.
Makes perfect sense. Thanks a lot. So maybe let's move on to other discussion topics. And if I may start this time on the borrower side, Markus and Manuel, breakage cost, calculation of commitment fees, credit adjustment spreads is something that obviously are important topics on the borrower side as well. What's your take on these three topics?
If I just start, I mean, I think a syndicated loan will look different in 2022 than it does today, because companies will pay commitment fee based on the margin. And currently we are in the interim situation that we have these credit adjustment spreads, and most probably they will be added to the margin going forward. So I expect for future contracts that the commitment fee will become lower. But this is just a guess from my side. I think I've not seen any proposal yet in the market. And when I talk to banks, I think they have no visibility on that yet. I think let's start first and then take these issues as they will come. I think there will be a lot of discussions. about such a topic, how they will be addressed. But this changes, I mean, the whole structure changes. It means as well that the underlying products will change in a way.
Thanks. Manuel, anything to add?
I think it's a good point. I think where you also as a borrower have to look at how the future will look like if you have put in this credit adjustment spread, or if you will just increase the overall margin, and what the impact it has on the commitment fee calculation. I think there is, to my knowledge, not yet so much clarity, and I think you can do it in many different ways. But just as the borrower to be aware of this problematic and see, what also if there will be a market standard.
Yeah. Any recommendations, Markus, from the Swiss Association of Corporate Treasurers in that regard, or relating to these topics?
No, I think first we all have to manage the current transition before we then move to the new products. And I think this will be very nice topics to be addressed and discussed next year. Maybe for a fourth forum then in 2022.
Okay, let's pencil that in. Maybe one question to all the participants. You, Markus, touched upon the system issues and mentioned that you expect the systems to be available also on the corporate side in Q3. Can you say any possibility for? Do you see any possibilities for workaround in the meantime if borrowers are approached by their banks and as we said, there is an increased pressure also on the financial institutions to move ahead?
I mean, we are approached by several banks now. It does not mean that they all have the same solution. They all come sometimes with different solutions. But from the IT side, I think, and I propose the companies to really very well plan and get in contact with their IT delivering companies, whoever this is, a third party or the big entities themselves, in case they need some resources, external resources. I propose the companies to plan that already now, because this is one of the events where everybody, the whole world more or less, has to change at the same time. And I could imagine that some external IT resources might become short and very hard available at that time, because everybody wants to do the same at the same time.
Makes a lot of sense. Manuel?
Yeah, and I would propose them to reach out to your system provider, because I think they are now running that process and they are adjusting their systems, and they should already have, I think, some material which is very good to read and just familiarize yourself with how the system change will look like. I think there's already some documentation available, and that you can plan also internally what you need. Maybe you need to load new rates and how you do this. And I think that as a corporate can already start now. Just reach out to your system provider and ask for as much as information as they can give you, and not just wait until they come to you.
Yeah, thanks, Manuel. Fabio, Chris, anything to add from the bank side? I guess financial institutions are ahead in that transition.
Yeah, I think we are largely ready for the transition, not 100% yet, but I guess that will be the case in the next couple of weeks.
Thanks. Chris, anything to add? Or?
No, I mean, obviously, just to add that this is an absolute key priority for us, and to a large extent, we are ready. Obviously, we're still putting a lot of work into this, but obviously the deadlines are clear, and we want to and have to be ready.
Yeah. So we said maybe it's worthwhile to shed a little bit more light on the Dormakaba transaction. We already mentioned it twice or three times. But Fabio, do you want to quickly explain a little bit the cornerstones of that transaction?
Yeah, sure. Thank you. We started the refinancing process of the pre-existing syndicated loan with Dormakaba last summer. And for the borrower, there were a couple of important topics. Firstly, the company wanted more flexibility with acquisitions. Also, the group wanted to include a sustainability link, and the group wished to internationalize the syndicate. And in addition to increase and extension options, we decided together with dormakaba to include transitional provisions concerning SARON. The borrower summarized all these points in a term sheet that we negotiated, and we then invited the 7 relationship banks of dormakaba to participate in the transaction, and then negotiated the credit facility agreement. Of course, I can't go too much into details due to the bank secrecy provisions, but I can give a quick overview. The facility has, as was already mentioned, a total amount of 525 million Swiss francs, and the syndicate consists of 8 international banks with ZKB as coordinator and agent. The facility is a 5-year term. And as I said, there's a sustainability link with UniCredit in the role of a sustainability coordinator. As for the transition to SARON, the base rate in the beginning is LIBOR with an automatic switch at a predefined switch date to compounded SARON in mid-2021. And following the National Working Group's recommendations, there's a look back of 5 banking days and an observation shift. And also the cumulative method is being used. The credit adjustment spread will be included prior to the switch date. And that's because when we set up the facility agreement, the ISDA rates were not yet available. So they will have to be included later this year along the recommended respective credit adjustment spread for the Swiss franc as determined by ISDA and published by Bloomberg.
Thanks. Also, maybe we can move again to a more general theme, the client handling in the SARON transition. Maybe I ask Chris, what is your approach in addressing the SARON transition with clients, both the existing syndicate market, but also with new kind of transactions?
Yeah, so I mean, obviously for those transactions where we're in the lead or agent, we are reaching out to borrowers with a view of how we foresee the amendment process. Obviously, it helps a lot that we have some structure provided by the NWG as far as amendments go. Generally speaking, it's certainly good to address the Swiss franc deals initially, also to gain a bit of experience, and then subsequently sort of the multi-currency setup. So like I say, we approached them with our view of things, and then we take the discussions as they go along, but obviously with a clear view of having the legacy positions amended way before cessation. And as for new transactions, I guess what we have been seeing is that whereas last year they tended to be documented still based on sort of the LMA revised replacement of screen rate clause, we have been seeing more facilities being documented with rate switch provisions over the last weeks and months. And obviously, as we head into the summer, we expect new facilities to be documented more on an ARR basis from the outset.
Thanks. Cam, from an international perspective, how do you see it, in particular in the London market? Is there a very active outreach?
Yeah, so I think you know, clearly with the milestones that have been in place, you know, a lot of people are focusing on the legacy book. I think one of the areas which seems to come up on a practical basis is this question of, you know, who takes the lead. So there are some institutions, you know, like Chris has said, that are being very proactive and sort of taking the lead where they, you know, are sort of the lead bank on the deal. But certainly, you know, we've seen in the UK market sort of people tending to sort of look at each other, because you obviously have the agent, but then the agent has an administrative role. So is it, is it really the agent's responsibility to take it? Is the lead bank still in the deal? And so this question does come up of who should be the one leading on the legacy transition. So certainly we've seen some banks take very proactive approaches. So some agents being the ones to take the proactive approach, some of the lead banks taking a proactive approach, some who are members of the syndicate wanting to take it. And again, this is something that was covered by the Dear CEO letter in the UK to try and address this point. And it's got an expectation in there that firms need to intensify their actions on legacy transactions now and take proactive steps. And it's set out that either the lead arranger or the agent needs to be the one taking forward the process. But it then also says that, legacy transition is a collective responsibility. So you can't just sort of sit back and think, I'm a member of a syndicate, no one's sort of said anything to me, I can sit back and wait for somebody else to do it. So, there's very much now actions being put on people to try and take this forward. And I think it's being driven forward now that we've seen obviously sort of new deals having to be based now on RFRs. Sort of people are taking those steps forward, but there are sort of conversations that do still come up. It's been touched on already, so discussions around credit adjustment spreads and what should you take as the methodology in this sort of in-between period, because you have the ISDA spread, but that's been sort of recommended for cessation and pre-cessation. So whilst the ISDA spread has been set as of the 5th of March, it doesn't actually then apply until June 2023 for certain tenors of US dollar LIBOR. So there's a question mark now about if you're transitioning a loan next month, what do you base your credit adjustment spread on? Is it the 5-year median, or is it the sort of the forward spread methodology that gets adopted for active transition in the derivatives market? So those are sort of question marks that are coming up and are dealing, that people are grappling with. But certainly it is something that's on people's radar. And I mentioned before, the other sort of aspect that I guess we're dealing with on an international context is this sort of position of the tough legacy legislation, and how much does that really help? So, yes, you have legislation that's been passed in the US market, but actually that isn't really going to touch on a lot of syndicated loans, because it really is dealing with loans that have, no fallbacks or a fallback to a LIBOR base rate, whereas oftentimes in the US, people have fallbacks to prime. And that's not actually caught by the legislation. And as I say, in the UK, the legislation hasn't passed yet. So we're in this sort of in-between period of people still thinking that they've got tough legacy legislation to help them, but it isn't as clear-cut as people might think.
Yeah, thanks, Cam. Bobby, anything to add?
We follow basically the same approach that Chris described. For ongoing syndicated loan, we will of course address the topic whenever an amendment is needed for any other reason. And for clients with existing syndicated loans where we're in the lead and no other changes are needed, we have started discussions and we'll seek to implement the same mechanic in the coming months throughout our portfolio, using the National Working Group's recommendation and also the standardized amendment agreement that was already mentioned by Alfred and Chris before. We're not expecting major difficulties to do so, but of course there's still a lot of work ahead of us, especially for my colleagues at the syndications desk. There might be some clients that would rather wait for more transactions in the market before they follow suit. However, that's a bit of a chicken and egg problem. So we'll be trying to convince those clients to tackle the transition in the coming months, because as was mentioned many times, the pressure is on to go ahead now.
Thanks, Fabio. Now looking at the time and also the points that we have already covered, I guess we are not going to cover any further the intercompany rates. We touched upon that, and the ISDA protocol. Manuel, you also touched upon that. I think we go now to the outlook to come to a conclusion. So looking at Q2, Chris, Fabio, what do you expect to happen now in the next, let's say, 2 months in Q2?
So yeah, I think a big focus is obviously going to be on amending existing contracts and making sure that we have all the provisions in place to actually facilitate the transition when it happens at the end of the year. I think there's a lot of work that's still to be done collectively, banks, borrowers, or law firms to the extent involved. And then obviously, like I said, as we head into the summer, that we then start seeing more transactions based on ARRs from the outset.
Yeah. Any recommendations to the borrower side?
I guess to the extent not already done, to familiarize yourself as much as you can with the information that's been put out by the national working groups, but also by various banks. I think there's a lot of good material out there. It can be a bit overwhelming almost, but obviously the better prepared we all are, the easier the transition is going to be. Thanks, Chris. Fabio, anything to add?
Yeah, it's probably a good idea to contact the agent of the facility to start discussions about the transition as soon as possible, and also discuss when an amendment should take place. But other than that, I totally agree with Chris. Yeah.
Thanks. Manuel, Marcus, same question to you.
Yeah, maybe I think yeah, you should not wait, so just tackle the problems where you can. For example, as we have touched upon on the intercompany loans, it's a little bit tricky, but we have seen, for example, at our cash pooling structures that you can already start looking at if you have reference rate, which is still Eonia or so, that you transition to Ester, or in Swiss franc that you have SARON. I think there you can already act. So just go through your list and try to deal with where you can, and not just wait until the last minute. Yeah.
Thanks, Manuel. Marcus?
As well, on our side, we hope to finalize the RCF in May. So then we have a new contract based on risk-free rates. As well, on our cash pooling side, we will continue the discussion with the banks to align here as well, that we can use the risk-free rates going forward in as many cash pools as we can, because the proposal for the time being were a little bit diverse, which rates to be used. I do not expect major moves forward on the intercompany loan side, as we've seen today. Still a discussion ongoing about these term rates or then these risk-free rates, as we only have the next NVG meeting beginning of July, definitely in Switzerland, they will have no proposal. And it only makes sense from a corporate side to use these term rates when you can use term rates for all the currencies. Otherwise, you really have a mixture which doesn't help the corporate side. So I do not expect any moves there, and I don't expect any moves in Q2 on the system side, as we had our discussion with our provider, and the system will only be ready to be tested in Q3.
Thanks, Marcus. Now the final word to you, Cam. What do you expect in the other jurisdictions?
Yeah, so I think in Q2 there'll hopefully be some much needed clarity from the FCA on what will be the scope of tough legacy. So which rates will actually have a synthetic LIBOR, and which rates, which products can actually benefit from that. So we're expecting that, particularly in the UK side, but obviously that will have an international impact as well. I think all eyes will also be on the US dollar market, because we touched a bit in the panel on the multi-currency issues, and also transition being at different timelines in different jurisdictions. So people opting a wait and see approach. But obviously, those using US dollars will need to know what rate to use by the end of the year. So I think there's got to be some clarity developing over the coming months, and it'll be interesting to see what happens there. But I do think, as I said at the beginning, the building blocks are pretty much in place there, and I do think that we'll see more deals coming out, especially in the London market, given the sterling deadline. So I'd hope to see more multi-currency facilities being entered into, and hopefully sort of setting some practice for the year to come.
Okay, thanks a lot. Then I would thank all the panel participants for your participation, and I would thank the audience for listening to us. Thanks for the interesting exchange, and as Marcus said, maybe we'll reunite for a fourth webinar to discuss follow-up questions and follow developments. So everybody have a very good evening. Thanks a lot. Bye-bye.